Hello, and welcome back to our channel. Today, we're diving into an important topic that affects everyone: insurance. Whether you're getting your first policy or just looking to understand your current one better, knowing the key terms can save you time, money, and stress. So, let's get started. First up, we have the term premium. This is the amount you pay for your insurance policy. It can be paid monthly, quarterly, semi-annually, or annually, depending on your agreement with the insurance company. Think of it as a subscription fee that keeps your coverage active. Example: if you have car insurance with a $100 monthly premium, you'll pay $1,200 over the course of a year to maintain your coverage. Factors influencing premiums. Factors such as your age, health, driving record, and the type of coverage you choose can all affect your premium. For instance, younger drivers typically have higher auto insurance premiums due to their lack of experience on the road. Next is the deductible. This is the amount you're responsible for paying out of pocket before your insurance kicks in. Higher deductibles typically mean lower premiums, and vice versa. Example: if your health insurance has a $1,000 deductible, you must pay the first $1,000 of your medical bills before your insurance starts to cover the costs. Types of deductibles. There are different types of deductibles, including per-incident deductibles, which apply each time you make a claim, and annual deductibles, which you only need to meet once per policy year. Another term you'll often hear is copayment or copay. This is a fixed amount you pay for a covered service, usually at the time of service. Example: if your health insurance includes a $20 copay for doctor visits, you'll pay $20 each time you see your doctor, with the insurance covering the rest. Variation by service. Copay amounts can vary depending on the type of service. For example, you might have a $20 copay for a general practitioner visit, but a $50 copay for a specialist visit. Coinsurance is the percentage of costs you share with your insurance company after you've met your deductible. Example: if your policy has an 80/20 coinsurance, after you've paid your deductible, your insurance covers 80% of the costs, and you're responsible for the remaining 20%. Real-world scenario. Suppose you have a medical bill of $10,000 and a deductible of $1,000. After paying your deductible, you still owe $9,000. With an 80/20 coinsurance, your insurance would cover 80% of the $9,000, which is $7,200. You would be responsible for the remaining $1,800. Your policy limit is the maximum amount your insurance company will pay for a covered loss. This can be broken down into different categories, such as per incident or annual limits. Example: if you have an auto insurance policy with a $100,000 limit for bodily injury, that's the most your insurer will pay for injuries per accident. Types of limits. There are different types of limits to be aware of, such as individual limits, per person, and aggregate limits, the total amount for all claims within a policy period. An exclusion is anything that your insurance policy does not cover. It's crucial to read your policy carefully to understand what's excluded. Example: some health insurance plans exclude certain types of elective surgeries, meaning they won't cover any costs related to those procedures. Common exclusions. Typical exclusions can include acts of war, intentional damage, and specific health conditions or treatments, such as cosmetic surgery or experimental treatments. In life insurance, a beneficiary is the person or entity you designate to receive the policy's payout upon your death. Example: if you name your spouse as the beneficiary on your life insurance policy, they will receive the benefit when you pass away. Choosing a beneficiary. You can name one or multiple beneficiaries and even specify the percentage of the payout each should receive. It's also wise to name a contingent beneficiary, who would receive the payout if the primary beneficiary cannot. A claim is a request made to your insurance company for payment based on the terms of your policy. This is what you file when you need your insurance to cover a loss or expense. Example: if you're in a car accident, you'll file a claim with your auto insurance company to cover the repair costs. Claim process. The process typically involves submitting a claim form, providing necessary documentation, like medical bills or repair estimates, and waiting for the insurance company to review and approve your claim. Underwriting is the process insurance companies use to assess risk and determine if they'll offer you coverage and at what price. Example: when you apply for health insurance, the underwriter will review your medical history to decide your premium and coverage options. Factors considered: underwriters look at various factors, including your age, health history, lifestyle, and even your occupation to determine your risk level. A rider is an add-on to your basic insurance policy that provides additional benefits or coverage. Example: you might add a rider to your home insurance policy to cover valuable items like jewelry or art that exceed the standard coverage limits. Common riders. Some common types of riders include disability income riders, accidental death riders, and waiver of premium riders, which can enhance your coverage according to your specific needs. And there you have it. These are some of the essential insurance terms you need to know. Understanding these terms can help you make more informed decisions about your insurance needs and ensure you're getting the best coverage for your situation. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more informative content. Thanks for watching, and we'll see you next time.